Namaste friends, myself Prakash Sharma. I am happy to share with you another episode of Pahal. Today we will understand about a topic with which many professionals are concerned, that is the filing of income tax returns under the Presumptive taxation scheme. Once the financial is over, many of us are under pressure to file the annual income tax return ITR. There is no need to take any tension. Today we'll learn about the basics of income tax and how easily you can file the ITR on your own with minimum hassle. We'll talk in detail about the sections related to maintenance of accounts, audit of accounts and filing of ITR 3 and ITR 4 under the Presumptive taxation scheme. If you want to get more knowledge about the basic concepts related to income tax and return filing, please watch my video on ITR 1, the link for which is shared here. What is Presumptive taxation scheme? Normally, books of accounts must be maintained and a profit and loss account and balance sheet must be prepared to know the income and the financial status of a business or profession. However, under the Income Tax Act 1961, a simple method has been provided for professionals to work out the income for tax return purpose. A person adopting the Presumptive taxation scheme can declare income at the prescribed rates. The different sections prescribing the scheme of Presumptive taxation are explained here. We will begin with Section 44AA, Maintenance of accounts by certain persons carrying on profession or business. Every person carrying on legal, medical, engineering or architectural profession or the profession of accountancy or technical consultancy or interior decoration or any other profession as is notified by the board shall keep and maintain such books of account and other documents as may enable to compute his total income in accordance with the provisions of this Act. The books or books of accounts include ledgers, day books, cash books, account books and other books whether kept in the written form or in electronic form or in digital form or as printouts of data stored in such electronic form. The sections provides every person carrying on business or profession not being a profession referred to in subsection 1 shall, if his income from profession exceeds 1,20,000 rupees or his total sales, turnover or gross receipts as the case may be in profession exceeds 10 lakh rupees in any of the 3 years immediately preceding the previous year, or where the profession is newly set up in any previous year, if his income for profession is likely to exceed 1,20,000 rupees as the in profession or is likely to exceed 10 lakh rupees during the year. So if the income is more than the given limits, books of accounts must be maintained. However, in the case of a person being an individual or a Hindu undivided family, the provisions of clause 1 and clause 2 shall have effect as if for the words 1,20,000 rupees, the words 2,50,000 rupees had been substituted. Similarly, in the case of a person being an individual or a Hindu undivided family, the provisions of clause 1 and 2 shall have effect as if for the words 10 lakh rupees, the words 25 lakh rupees had been substituted. So, in case of an individual or HUF, the prescribed limit for maintaining books of account is higher as compared to other assessees. Now let us come to section 44AB, audit of accounts of certain persons carrying on business or profession. Every person carrying on profession shall, if his gross receipts in profession exceed 50 lakh rupees in any previous year, get his accounts of such previous year audited by an accountant before the specified date and furnished by that date the report of such audit in the prescribed form duly signed and verified by such accountant and setting forth such particulars as may be prescribed. To relieve the small taxpayers from such compliance burden, the Income Tax Act has framed the Presumptive taxation scheme under Section 44AD, 44ADA and 44AE. A person adopting the Presumptive taxation scheme can declare income at the prescribed rate. The Act has provided the scheme as explained. Section 44ADA, special provision for computing profits and gains of profession or presumptive basis. There is a threshold limit to opt the Presumptive taxation scheme. The threshold limit is Rs 75 lakhs if the aggregate of professional receipts in cash or similar mode does not exceed 5% of the gross receipts in the year. Otherwise, the limit is capped at Rs 50 lakhs. Following are the specified professions: legal, medical, architectural or engineering, accountancy, technical consultancy, interior decoration, or any other profession as notified by CBDT. However, notwithstanding anything contained in sections 28 to 43C, in case of an individual, in case of an assessee being an individual or a partnership firm other than a limited liability partnership who is a resident in India and is engaged in a profession referred to in subsection 1 of section 44AA and whose total gross receipts do not exceed 50 lakh rupees in a year, a sum equal to 50% of the total gross receipts of the assessee in the year on account of such profession, or as the case may be, a sum higher than the aforesaid sum claimed to have been earned by the assessee, shall be deemed to be the profits and gains of such profession chargeable to tax under the head profits and gains of business or profession. However, in case of an SSC where the amount or aggregate of the amounts received during the year in cash does not exceed 5% of the total gross receipts of the year, this subsection shall have effect as if for the words 50 lakh rupees, the words 75 lakh rupees had been substituted. Let us understand the ITR forms. ITR 3 applicable to individual and HUF engaged in business or profession. Here both tax audit and non-tax audit cases under the presumptive taxation scheme is not opted. And those who are not eligible to file ITR 1, ITR 2 or ITR 4. ITR 4 is for resident individual, HUF firm other than LLP having income under business or profession under section 44AD, 44ADA or 44AE computed on a presumptive basis. In India, there are nearly 2.5 crore taxpayers who file ITR 4. Only the taxpayers having income from the given sources not exceeding rupees 50 lakhs is eligible to file ITR 4. The sources are number 1 salary or pension, number 2 one house property, number 3 other sources like interest, family pension, dividend etc. excluding winning from lottery and income from race sources. Number 4 agriculture income up to rupees 5,000 and number 5 long term capital gain under section 112A up to rupees 1,25,000. ITR form cannot be used by a person who 1. is a director in a company, 2. has held any unlisted equity share at any time during the previous year, 3. has any asset including financial interest in any entity located outside India, number 4. has signing authority in any account located outside India, number 5. has income from any sources outside India, number 6. is a person in whose case payment or deduction of tax has been deferred on ESOP. Number 7. has any brought forward loss or loss to be carried forward under any head of income. Number 8. has total income exceeding rupees 50 lakhs. Number 9. has income from short-term capital gains. And number 10. has income from long-term capital gains other than under section 112A up to rupees 1.25 lakhs. Please note that ITR 4 is optional and not mandatory. It is a simple form compared to ITR 3. However, one must be eligible to file ITR 4. The category for SSCs and their due dates for filing of return for individual and HUF, it is 31st July which has been extended to 15 September for the financial year 24-25. However, it is for the cases not requiring audit. Now let us understand the tax slabs for individuals who are less than 60 years of age. Under section 115 BAC, new regime for the financial year 24-25. If the taxpayer income is less than rupees 3 lakhs, no tax to be paid, the rate is nil. From rupees 3 lakh 1 to rupees 7 lakh, it is 5%. From rupees 7 lakh 1 to rupees 10 lakh, it is 10%. From rupees 12 lakh 1 to rupees 15 lakh, it is 20%. From rupees 50 lakh 1 to rupees 1 crore, 30% plus surcharge of 10%. And under the last slab, any income above rupees 2 crore will be taxed at 30% with a surcharge of 25%. Coming to the selection of tax regime. After the amendment by Finance Act 2024, the new tax regime is the default tax regime for an individual HUF. However, the assessee has the option to opt out and choose old tax regime and withdraw from it in any subsequent year can be exercised only once in the lifetime of a taxpayer having income from business and profession. For this purpose, Form 10 IEA has to be submitted before the due date of filing ITR. The rebates under Section 87A under the old regime and assessee being an individual resident in India whose total income does not exceed 500,000 rupees, that is 5 lakh rupees, shall be entitled to a deduction from the amount of income tax as computed before allowing the deduction under this chapter on his total income, which is chargeable for any assessment year of an amount equal to 100% of such income tax or an amount of 12,500 rupees, whichever is less. So under the old regime, the rebate amount is 12,500 rupees. Under the new regime and covered under section 115 BAC for financial year 2024-2025, where total income does not exceed 700,000 rupees, that is 7 lakh rupees, the assessee shall be entitled to a deduction from the amount of income tax as computed before allowing for the deduction under this chapter on his total income with which is chargeable for any assessment year of an amount equal to 100% of such income tax or an amount of 25,000 rupees, whichever is less. So under the new regime, the rebate amount is rupees 25,000. Some of the forms applicable for ITR. Form 16, which is certificate of tax deducted at source on salary, which is covered under section 203. This is provided by employer to employee and it provides the salary income detail and the TDS detail. Form 16A is certificate of tax deducted at source on professional income. This is provided by deductor to deductee, nature of payments, income credited or paid and TDS details are covered under this. Form 26 AIS Annual Information Statement. This is provided by Income Tax Department. It provides the income and TDS details. Please note down the income tax website. It is eportal.incometax.gov.in. You can log in by going to the home page. The login tab is provided in upper right hand corner. Use PAN number to log in, and if you have not yet registered, use your PAN to create your login ID. Once you have the necessary data available with you, log in to the income tax return filing portal and follow the given steps. Normally you will require the following: bank statement, housing loan certificate, interest earned certificate, insurance receipts, rent receipts. The income tax site is user friendly. Please link Aadhaar and PAN if not yet done. First, familiarize yourself with all the sections which you need to fill up. After filling up the data, there is a process of validation which ensures that there are no logical errors. You can download the filled form for your review. If there are no discrepancies, you can do online verification. Please share this video with as many persons as possible so that they can also benefit. You can write in the comment section for further clarification, feedback, or a free consultation with me. I hope to get your encouragement to produce more such videos on matters of interest to the common man. Kindly like and share the video and subscribe to my channel. Thank you for watching. Have a good day.